We're going to do chapter 2 in one day today and basically kind of race through it. And I hope that, we get through okay, but we're going to hit the high points. And basically, I'm not going to concentrate as much on the things that I think will be obvious in the book from reading the book, beginning with this conceptual framework, which is kind of the standards and practices that have been developed. And here, just showing that the first three of these parts of the Statement of Financial Accounting Concepts have been superseded. And what we're going to concentrate is on really number 5, 6, 7, and 8. And these are the things that we're basically going to go over today. First, starting with the number 8, the objective of financial reporting. Okay? So that's our first section, the objective of financial reporting. Well, and then this, pointing out that this right here is kind of the framework of what we're going to go over, and it's on page 62. So if you want to look on page 62, we're really going to start at the bottom of the triangle where the blue part is. That's the objective. And then we're going to move our way up and go next to the qualitative characteristics, then the elements, and then up there to the assumptions and such. Okay. You can pass that back too. All right. So now to go to the objective of financial reporting. I think we've talked about this a little bit. What are we trying to get to in financial reporting? What's our goal? And so we want to present information, financial information, that's useful. So we want to make sure that the information that we give them is useful to make decisions. So it's a decision-making, kind of emphasis. What kind of information would be good for making decisions? And who are the users of the financial statements? Primarily, it's the stockholders and the creditors. But the ones that we're primarily interested in financial accounting is, who's our main user? Management, is that right? In financial accounting? So we have two types of accounting, right? Financial accounting, managerial accounting. Financial accounting was principles 1, managerial accounting is principles 2. We're in intermediate accounting where we're working on financial statements for the public. Which part of the public? Keeping in mind our main users are equity investors and creditors. Which ones of those, equity investors meaning stockholders, creditors, people that are considering loaning us money, which ones of those are we interested in? Both, but the main one is the stockholders, okay? The stockholders are the main ones we're interested in, okay? The potential stockholders, okay? In making decisions about providing resources to our company, okay? So stockholders are our main users. Okay, so what things make information more useful? What kind of characteristics? That's what we mean by qualitative characteristics. What kind of characteristics would be more useful in making decisions about equity investments? Okay, so that's the qualitative characteristics just give us an idea of what kind of things are more useful, and we're assuming here that the users of the financial statements have a reasonable business knowledge, that they're just not people off the street, okay? Okay, now we're looking at relevance. This is one of the qualitative characteristics. Do you see relevance is the A there in the box, okay? So we've looked at the objective, the thing in the blue box, and now we're going to go to relevance, which is A in the middle left box. Okay, so just to kind of take a step back, the primary qualitative characteristics are the fundamental qualities of qualitative characteristics are relevance and faithful representation, so the A and the B. And then there's some other enhancing qualities beneath that. But the primary things that are going to make information better are relevance and faithful representation, okay? So another way of thinking about this is what they used to call it, relevance and reliability, okay? Faithful representation used to be called reliability. So to me, that's kind of easier to remember. But, okay, so what kind of things make information relevant? That's what we're going to look at now. There's really three things that make it relevant: predictive value, confirmatory value, and materiality. Now let me just say about the things in the triangle, it's not so important to me that you know where these things fall in the triangle or whether relevance, you know, which part relevance is. It's just more important to me that you can define what predictive value is or what confirmatory value is, and that these are good things to make the information useful, okay? So relevant information, the thing that makes information relevant is that it would change somebody's decision, okay? So it must be capable of making a difference in somebody's decision, okay? So by that we mean a lot of information is good to know, right? Okay, great, that's good to know. But is it important enough information to change somebody's mind about making a decision? Okay? So, I don't know, maybe, let's say it's raining today. Let's say I'm planning to go to the football game. Let's say I'm planning to go to the Georgia football game, and let's say last weekend, and let's say the chance of rain was 20%. Okay, is that information relevant? I mean, would it make a difference to me to know that information? Chance of rain is 20%. Or how about this? Would it make more of a difference if I knew that the chance of lightning is 100% and the chance of a tornado is 100%? You know, there's just a difference in how, relevant it is to my decision, or if I'm just going to be hanging out in my house, then maybe I don't care if the chance of rain is 20%. Do you see what I mean? There's a certain degree of how relevant it is to somebody's decision to be useful. Okay, so predictive value, let's think about the difference between predictive value and confirmatory value. Okay, those are the first two. Okay, predictive value has to do with the future. Predictive value has to do with the future. If information has some kind of impact on about their expectation about the future, then that makes it more relevant. And exactly what kind of information are stockholders looking at to know about the future? They'd like to know about the cash flows, cash flow information. Remember we talked about that before, that cash flows are more important to investors than anything else. What is their chance of getting some cash back from this investment? Okay? And specifically about the cash flows, they'd like to know about the amount and the timing and the uncertainty of the cash flows. How much cash flow can they expect? That's the amount. When can they possibly expect it, the timing, and the uncertainty, is there any kind of risk there? Okay, so that's predictive value, information about the future. Now remember, what kind of information do our financial statements usually tell us about? Like the balance sheet. Does it tell us about the future? What does it mainly tell us about? The past, right? Yeah. So see how already we're kind of behind the 8 ball. you know, but the investors use this information about the past to create expectations about the future. So is our information good enough to allow them to create their future expectations? Okay, so confirmatory value helps users confirm their prior expectations. So these are looking at two different kind of things. Now, materiality. We can't tell everybody, we can't tell the users the intimate details of the company. We only want to give them the most important information. In other words, we want to give them kind of a top-level view, a higher level view that only tells them about the most important information. So you guys had a assignment where you looked at the financial statements of a company, right? Most recently. Now, on the income statement for the company that you looked at, how many lines were listed as far as how many income or expense items were there? 1,000 on your income statement? Not longer than a page, really maybe even half a page, right? Wasn't it usually kind of short? Were you surprised at how short it was? Okay, so these were large companies, right? Super large companies, but yet they only gave you a few lines about their income. And why is that? Because users might not want to know all the intimate details behind all, they want a nice, large view. And that's what materiality is all about. What number is big enough to change the mind of a user? Okay, so like for Target, let's say, if I'm thinking about investing in Target, I don't really know their numbers, you know, but I would assume that they have more, you know, millions, if not more, in like, well, maybe even gross income, a ton, right? So would $1,000 of income make a difference to me in Target? $1,000. If their financial statements were off by $1,000, would I be likely to say, well, just forget about it then? I'm not interested. That's not a big enough number, right? So there's got to be a level to where if it was $1 million, let's say, maybe that would get my attention. So in other words, there is a number, a relative number that users would change a user's mind. If things were off by that number, it would be enough to change somebody's mind. Okay? So that is what materiality is. Whatever that number is for that particular company. Now, let's say I'm a company, and let's say I knew that my bank statement was off by $1,000, right? Or somebody stole $1,000 from me. Let's say that. I was missing $1,000, okay? What would I think? Would that number make a difference in my decision making? Would that number be important to me? Or how about y'all? Would you care about $1,000? Yes, okay. $1,000 is big enough to make a difference in your decisions. But so the number, it's relative for the size of the company. The number that's material for one company would not be material in another, okay? So how do we decide what is material? There's two types of materiality, quantitative materiality and qualitative materiality, okay? So on the top line, the quantitative materiality is a percentage of net income is like the kind of default materiality number, 5% of net income. So that's not a hard and fast rule, it's a rule of thumb. So given nothing else to go on, this rule of thumb is 5% of net income. And that's usually good for companies that are the type of companies that have net income or that's their goal. You know, so it wouldn't be good for a not-for-profit company, let's say, or maybe a governmental utility or whatever. There might be other rules for them. But for an income company, it would be 5% of net income. Now, but there are other factors that make materiality vary from that. Because it could be that, net income tends to ebb and flow, and there could be other factors that users would look at. And they're listed there under the qualitative factors. Okay, first is, if a number is going to change a loss to a profit or a profit to a loss, even though it might be less than that 5% number, then that would make a difference to people. If you thought your company was making money and then all of a sudden something wasn't entered correctly or whatever, and then instead they're losing money this year, that would likely affect your decision making. Or if somehow there was some fraudulent thing that went on that was less than the normal materiality level, or if it allowed companies to make their earnings target. Okay, so let's just stop right here and talk about how important these earnings targets are for companies. What users of the financial statements want to see is increasing earnings. Okay, so if a company's earnings are going like this, so like they increase from one year to the next, this is year 1, year 2, year 3, like that, and it means their earnings per share is growing and increasing. This is the type of thing that users want to see, right? So, what if in year 4 earnings did like this, right? Does this upset the users of the financial statements? Yes, it does. And likely your stock price will go down if that happens. They're very, stock prices are very susceptible to earnings trends or changes in earnings trends. So sometimes companies have an incentive to try to move the earnings from here to here. So they have a big incentive to try to make their earnings in year 4 go up to continue the earnings trend. Do you see that? So they're likely to, management is likely to try to do things to push the earnings up. So, it might be as simple of, we need to sell a lot more product this 4th quarter because looks like we're missing our earnings trend, right? Go out there and sell stuff, right? Or there might be something that they could do to cut expenses or whatever to help get to this earnings trend. Or there is, occasionally there's times when management will try to influence the financial statements in, kind of crooked ways to make their earnings look better than they actually were. So that's why it's important to kind of watch these qualitative factors down here. Okay? Okay, any questions about this? Any questions so far? Okay, so now we are to faithful representation, which, remember I said, used to be called reliability. Okay? So what are the 2 things that make accounting information more useful for decision making? What are the 2 things that make accounting information more useful for decision making? This is what we're talking about. It's the qualitative characteristics, relevance, and faithful representation. Okay? Now we're going to talk about the faithful representation. Okay? That means that the information it represents what really happened. Okay? The information tells us something about what really happened in the company. It faithfully represents the numbers. Okay? So it's a true picture of the company's actual earnings or financial position. Okay? What things make it a better representation of what really happened? These 3 boxes here: completeness, neutrality, and free from error. Okay? In other words, what the company's telling us with these statements is the truth, the whole truth, and nothing but the truth, right? Okay, so completeness means that all the information is included. There hasn't been something that's left out. For instance, they haven't left out the big, terrible, bad news that happened right there on December 30th that we would not be happy about. They put everything in there, okay? Neutrality means that they didn't selectively choose information to make it appear to be better than it was. In other words, it was unbiased. They provided the information no matter whether it was good or bad. So they didn't slant it in one way or another. Because the company's typical slant would be what? To make themselves look better than they really were, right? They didn't try to make themselves look better than they really are. A lot of times what people say is they provide the information, warts and all, okay? We're not putting makeup on a pig, We're providing a true picture of what things looked like. Lipstick on a pig, have y'all heard that? In a political race, that was a recent little saying, okay? Free from error. Information that is, there are not any mistakes in the information. The information is accurate, okay? Still, not everything in the information is, exact, plain vanilla numbers. There are judgments in the information. But what we're saying here is that you can still use the estimates and use some judgment, but that it's basically accurate information. Okay, so we've talked about the two things that make information more useful, relevance and faithful representation. Now we're going to talk about some other qualities that make information useful. And those are those blue boxes down at the bottom, okay? And remember still, we're going on that inverted triangle that's in the back of the book, right? Okay, so comparability. So there's two types of comparability here. One is, or the main idea in comparability is that we're comparing, we could use this information provided by the company to compare it with another company. Okay, so like if we take Ford Motor Company's financial statements, then we could compare those financial statements to what? Like GM, okay? That the financial statements, the information in there is able to be compared. We could see maybe what the differences are. And we could maybe reconcile the differences to see which company might be doing a better job, right? We want information to be able to be comparable. Now, another type of comparability is comparing it with last year's numbers. And, financial statements always have at least 2 years' numbers so that you can see what happened last year, right? So it's very important that for this company, you're able to look at last year's numbers and be able to compare those numbers, and that makes the information better. So we call that same company, different periods, we call that consistency. Okay, so under comparability, we want to be able to compare different companies, and we also want to be able to compare this company 1 year to the other, and that's called consistency. Okay? Now the next one is verifiability. So verifiability happens when someone else who was providing information would come out with the same numbers. Okay? So what happens? Management comes up with financial statements. Then they bring in CPAs to look over the financial statements and to certify that those were present fairly, that the financial statements present fairly, right? Okay, so what happened then is the CPAs, the audit firm, has looked over the numbers and agreed with them, and they are independent measurers, right? And the idea is, even if we came up with those auditors or other auditors, the numbers would stay the same. people wouldn't come up with different answers to the problem, right? So that is verifiability. The numbers are verifiable. There's enough information in there to back up the numbers, okay? Timeliness. Okay, so information is timely if it is soon enough for the users to make decisions by. Okay, so users are trying to decide about what to do, buy or sell stock in a company. They want information to be there soon enough to influence their decisions. Okay, so we can't wait years and years to get the financial statements, right? We need them to be timely. But what's the problem with timeliness? How timely is our information? How soon after year end do we get information? It's months, right? So maybe, as a matter of fact, you wait all year for the year to be over, and then a couple of months later, then you have the information about what happened all of last year. Now, we do provide quarterly did y'all notice that when you were looking up the SEC reports, that they're quarterly reports that were filed also? In addition to the 10K, they're quarterly SEC reports. So that's nice that there's updates during the quarter. But then even then, with quarterly updates, you can go 3 months without anything happening. So you see how if you only knew how much was in your bank account every 3 months, would that be super useful? You know, more frequent would be nice, right? Okay. Because pretty soon you'll just give up on that and, you know, say, well, that's maybe not all that helpful. You know, bank statements used to come once a month, right? Now, how often do you know what's in your account? Every day. 5 times a day if you want it, right? So that's pretty timely. You know, banks have improved their timeliness, but still financial statements haven't improved their timeliness in many years, you know. It's been quarterly for a very long time. Okay, understandability. Well, understandability, how easy was it to understand the financial statements that y'all looked at, right? I mean, there's a lot of detail there. And but we want information that is understandable. And that's one reason it's kind of condensed down. And that's one reason that the notes are in a separate place so that all the details are somewhere else. So we want the information to be classified in a way and characterized and presented in a way that's useful, okay? So classified, you know, we separate things